Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
What have stocks done from a buy and hold perspective? What has real estate done from buy and hold? What have bonds done from buy and hold? What has gold done? And that's the extent. And here the CTAs sit with, hardly any of our commodities are worth a damn on buy and hold. But if you let me wrap it inside my trend follower, they all spring magically to life and they add value. They add diversification, they add profit to your portfolio, but I've got to wrap it up in trend follower. And so I think that's the lesson, is not the individual markets per se. Trend following can take something that loses money on a buy and hold and raise it from the dead. And it's a beautiful addition, long and short, to your portfolio.
All right, thanks for joining us on this episode of The Derivative. I'm your host, Jeff Malik, and we're going back to our managed futures trend following roots today and diving into a conversation with someone who has helped as much as anyone grow that alternative seedling into a massive oak of a tree. We've got turtle trader turned managed futures magistrate, Chesapeake Capital's Jerry Parker. Welcome, Jerry.
Thanks, Jeff. Thanks for having me. I'm glad to be here.
Yeah, it's been fun. So Jerry's still one of the most influential proponents of long-term trend following strategies in the industry and regularly shares his insights on the ins and outs of trend following portfolios, asset allocation strategies, and more via Twitter. But we're lucky to have him here in the flesh, so to speak, the virtual flesh today, and excited to dig into turtle trading, trend following, and much more. So thanks again. Where you're down in Tampa?
That's right, Tampa, Florida. It's very warm here, and it's good to be inside like I am most of the time. And but I can assure all of the watchers and listeners that almost all Floridians are doing all they can to wear their mask and social distance and be responsible. So I hope it rewards us with some better numbers here soon.
Yeah, the news doesn't seem to have that same feeling on Florida, but hopefully it's sunk in now. People have got the mask on.
Oh yeah, mask everywhere. No problem wearing the mask. Yeah, not sure what's going on, but we're trying not to be too sensitive. But the rest of the country is looking at Florida to do better, and I think we are.
And then, so you ran Chesapeake out of Richmond for years and years, right? When did you make the move down to Florida?
Well, Chesapeake officially is still in Richmond, and still have our core group of people that we've had for 30 years or 25 to 30 years. And I moved down to Florida in 2011, but I go back to Richmond fairly often and still have my house in Richmond, and I love Richmond. And so technically Chesapeake is still there. I'm just, old people move to Florida. So that's why I'm down here.
Right. You're not that old. And those were two of the least hotbed of hedge fund places in the world, right? Richmond, Virginia, and Tampa, Florida. There any competition in either of them?
Yeah, it's funny you bring that up because I think that over the years, in the early years of managed futures, it's changed a lot. And to some degree, I was there in the beginning, kind of the beginning, But I remember the old saying, being a CTA and in managed futures is great. One of the great reasons is because you can live anywhere. And what that doesn't say is you should live anywhere. You can live anywhere, but I think, as a business, we kind of missed out by not being located in more of a hot spot for clients, New York, Chicago, places like that. I'm sure some firms have done well regardless, but it definitely cost us by thinking, there wasn't a downside to being in a small town outside of those major hubs.
You may have made up for it in cost of living savings over all those years. So who knows? Who knows who's right? I think this coronavirus and all the Zoom meetings and everything everyone's doing is going to totally wipe that whole concept off the board. And you can be a hedge fund manager anywhere, right? I've already seen it with allocators. They're going to more Zoom meetings and they're realizing, yeah, we don't have to get on the plane. Let's just get on a video.
Yeah, I agree. I really enjoy the webinars and podcasts, and it's one of the good things that came out of all of this, for sure. But I think that there's a hedge fund community in New York and Chicago where I had my first training, and I think there's a community, there's camaraderie, and being around friendly people like that who understand. There's possibilities of hiring people, being hired, sort of collaboration to some degree. And I think that's one of maybe the mistakes or issues that the Turtles didn't do well, which is there was no collaboration. There was no 2 or 3 Turtles going out together and starting their own business. And it's kind of important to have a good team of people. We just all headed for our hometown, and probably would have worked out better if we would have thought along those business lines a little bit more to make sure we had a group of good, smart people together rather than trying to recreate a business, each individually on our own.
Right. And so you touched on that a little bit with the turtle story. So you've got one of the best origin stories around with the turtle traders. Can you give us a quick rundown of what that was, what that looked like? Maybe some pieces that aren't usually talked about?
Yeah, of course. It was just a great experience. And I knew in the fall of 1983, when I was living in Richmond, Virginia, and in public accounting, that this was going to be a great opportunity. So I saw the ad in the Wall Street Journal, which is, a fair amount of luck. And then I applied and I got an interview and got the job. So it was quite a fun time learning from really genius people. I just don't really think people understand how genius Bill Eckhart and Richard Dennis are and were at that time. And there was always an emphasis on computer testing and back testing and research. And so it wasn't really just Rich and Bill coming off the floor and with some rules and giving us these rules. It was some hardcore math and back testing and computers. And, I don't know of anybody that I think is smarter than Bill Eckhart. He's kind of it's humbling to listen to both of Rich and Bill, talk, because it's just another level of human being. And so we had great mentors, as it relates to systematic and trading, what to do. And there was a big emphasis as well on the future, how to evolve over time and how to do it the right way. I had a very slow start. I didn't really do well performance-wise.
What year is this? What year did you answer the ad?
So January 1984, we started with $1 million to trade of Rich's money. And we had a 2-week training course, maybe 3. I can't remember if it was 2 or 3 in the around December of '83. And so in '84,
I hope it was 3. It seems a little odd to just, hey, 2 weeks training, you're good. Here's $2 million. Here's $1 million.
No, I should say it was like 3 months or 6 months or something like that. It sounds a lot better. But we were handed the system. Here are the systems. Here's what our research says. Here's what the computer says. And during the course, Rich would frequently say that, what does the computer say about this question? If someone had a question, what's the computer say? And so we were just spoon-fed and given all of this great information and just told, hey, basically follow the rules. Part of the goals I think Rich and Bill had for the Turtles was 2 things mainly that they said was, we don't really have the desire to follow the rules as much as we probably should. So the money that we allocate to the turtles will allow us to have more fun. We can do our fun trading, and we know that there's a certain amount dedicated to following the systems entirely. And then number two was they really wanted us to offer some ideas that we saw in the markets and what was happening. And here are the rules we gave you, but just come to us and let us know if you see something we should test and possibly incorporate into the systems.
And so was it a bet between them, or they were trying to kind of build their own prop firm? Or how do you remember it? It kind of gets remembered different ways throughout history here all of a sudden.
Yeah, I don't think that I've noticed over the years, they don't really like the idea that it was a bet. I don't think it was a specific bet necessarily, but I do think that they both had difference of opinions on to the degree that trend following or systematic trading could be taught. And so I think Rich thought, yeah, you could teach it, no problem. I mean, you just got to follow the rules, basically. Evolving over time and making the systems better. And as the markets change, how are you going to improve? That's something different. But and then I think Bill's idea was, no, you probably can't teach this stuff. But I think they both came to the conclusion that, obviously it's fairly teachable. But there was a very, I think once when we were there for those 4 years, we were making between 100 and 200% a year. And I think people made about the same amount of money. And I remember Rich saying, basically all the turtles are created equal. But then when we went off on our own and we were kind of free to do what we wanted to do with no one watching us, then people's strategies really changed over time.
So how did your evolution come about? What was your core that you kept, and what was the changes that you made?
Well, the core that I really kept and that I'm obsessed with is diversification, maximum diversification, and trading lots of commodities and currencies and stocks and bonds. And I even got into single stocks to replace stock indices, which I thought was just totally normal and natural to expand the real diversification that you would want in stocks and get away from the indexes. But I stayed very true to the trend following and the money management. I would have changed in an instant. I'm very interested in copying other people and doing whatever it takes to succeed. So I would have no problem at all reading something, and I would really read a lot and try to read about Harding and Aspect and Transtrend and all of these European guys and the US, John Henry and Graham and people like that, and trying to figure out something, anything that I could find. But I basically couldn't find anything that I thought was better as it relates to the money management. And then, of course, the biggest evolution has really been just the look back period had to be longer term. When we were making 200% a year, our average holding period was a month or less. And now it's probably like a year. So that's just dictated by the change in the markets where it's not really.
And do you have numbers on that? How much more volatile were the markets in the 80s while you guys were trading it?
Well, I just think that there was less choppiness. And so you would have a trend that would last a month or two, and then you could profit from that with a short-term system. But now the short-term system would, that same systematic approach, the back testing doesn't look good, and you just keep getting bounced out of the trade, and it goes right back to the highs. So you have to keep getting in and getting out all the time. So that seems to be what everybody in the industry sort of picked up on, is that in order to be profitable, we've got to be longer term. Now we need to also figure out, if we're going to be longer term, obviously, how do we not give back all of the profit? Something like palladium is a great example. In order to stay in that trade, gold, this gold trade, the recent palladium trade. In order to stay in those trades, you need to have a loose stop, trailing stop, so you don't get bounced out. But then when it crashes, like palladium did, that that trailing stop that's pretty far away will give back all of the profit. So some people do it with.
So you're saying this recent in March, palladium sold off huge?
Yeah,
Yeah,
exactly.
and it'd been up like, I can't remember the number, 60 some percent in 19, something like that.
Exactly. And then all the profit, or too much of that profit went away very quickly. So what are you going to do to preserve that? You need to be longer term, but then if you're too long term, when the market turns, you may give it all back. So that's what we're kind of paid to do, is figure that out. And something.
Do you feel, I feel the industry's moved almost too far that direction, right? They've done two things: become more long-term and added more long bias. So it feels like in the next, maybe they dodged a bullet with this crisis, but in the next crisis of an '08 type, that those two things might combine to have worse performance than, if we had a exact 2008 replica market in 2021 or something. I feel like they wouldn't put up the same performance as was in '08. You got any thoughts on that?
Yeah, I mean, if you look at '08 compared to 2020, it's a very good thing to compare. So let's just talk about the S&P. So in 2020, we've seen a lot of research and papers written recently about how important it was to trade shorter term. So the shorter term, the better. It was such a dramatic cliff drop that you got to get out of the longs quickly and get short quickly, because the volatility picked up so fast, and then the market just sold off really hard. Made it hard for long-term trend followers to do well this year. Then in 2080, when the S&P broke, the S&P made a 200-day low in January. So it was very near the high. And it was very easy to get short that market with a long-term look back. So ever since then, though, it has not been the case. All of the stock market sell-offs have been more crashes rather than spending some time in a level and consolidating around and allowing the long-term look back to be close to the all-time high, for instance. So we got lucky in '08, and we haven't been lucky since. But then in some of the other markets this year as well, the emerging currencies, energy not so much. That was not a tough trade to get short quickly. But some of the other markets, especially the S&P, just the quicker you could get out of that long and go short, that was going to determine your relative performance.
And energies, I feel like it was on the flip side, right? When it started rallying back up, that was way too quick for trend to capture.
That's right. I mean, if you're going to exit that energy trade, that crude oil short, using that long-term system, that long-term exit, it's going to be some major give back. So a lot of traders, the way they combat that is they do the volatility targeting to reduce the position as the vol increases. So that helps you kind of take profits a little bit and reduce your risk. But that crude got volatile very quickly. And so you were getting out of that crude too quick, too soon, before it made those really nice lows. So I really just feel like that's what's, we're paid to do, get in the trade, stay in the trade, don't get out too quickly. Then what are you going to do when you have these V tops and V bottoms and lots of volatility? You've got to add these things to your approach where you don't give back all of the profit, but you stay true to your trend following.
So to me, that's become right. People kind of lost patience with that approach over the last 5 to 10 years, right? Since the '09, we've had trend following. Managed futures has had maybe 1 or 2 good years, 14 and 18 sort of. So how do you square that of like, yeah, this is our job. We got to make sure we can manage these snapbacks and this volatility. But if the market's not delivering that, is it broken? Is it a change in environment, or we just have to be patient as investors?
That's a good question. I mean, I was prepared for that question, so it's not like we haven't heard it before. But
Right.
yeah, so my description just a second ago was of actual trades, and we didn't handle those. They're difficult to handle. Maybe the average CTA did not handle those actual trades, in 2020 as well as we had hoped. So now, but now you're talking about the past 10 years. So I just think that to get quickly to the punchline, the problem is we just haven't had enough long-term trends, especially trends on the upside. I think anytime you have a CTA, a trend follower, talking about their short trades, even though I appreciate the crude trade in 2014, and we're short a lot of the commodities now, and they have small profits, and I appreciate those. You're in trouble if that's all you can talk about is your short commodity or short trades in general. So we just haven't had enough of these outlier moves to the upside that we used to have, that when we did the back test, the back test said, hey, you should trade long-term trend following.
Right.
So
In spades, right?
You can blame that on us or me. Why did you choose a methodology that was so reliant upon outlier trades? Well, we had 2,000, 5,000 trades. It goes back 30 or 40 years. You have a huge sample size. Those trades are there. This is what we should do. And people are like, yeah, and it's been working. Then all of a sudden, we don't have those long commodity trades. And this is coming from a group that prides themselves on delivering diversification, being different. And how are you really going to be different if you don't trade some commodities? Love the commodities. They're so much different. They have great trends, but then the trends go away. We don't really have any great long-term trends. We get a few in gold and some, but very few in the past 10 years. And we need more than just a couple. And so
the billion-dollar question, right? Is that a feature or a bug? Like, is that the new environment for whatever reason because of algorithmic execution or more quant funds out there, or who knows what?
Well, I think if we just, we did get some nice uptrends, like you mentioned in 18 in the bonds, that helps. And the stocks, of course, we've had some good uptrends in the stocks, but half of our portfolio is in currencies and commodities, and they really haven't done very much. So I think that if we had seen nice commodity trends and currency trends, and we just gave back all the profit, and we just, they were there, but we didn't capture it, we could say, okay, the systems are broken. But I don't think that they're broken, but it may be irrelevant if we're not going to get whatever it took, inflation or just normal monetary policy, or normal economy. I guess we all think it's kind of not that normal these days. So, and if we don't get those commodity trends back, we're gonna maybe have to all switch to trading stocks. I don't know. It's
right.
What do you do?
Let's talk about how do you square, right? So we had that huge trend in palladium. So there is one trend that happened, but you can't risk enough to make that worthwhile for the portfolio, right?
Oh, that's right. And, we think it's a huge advantage to trade 100 markets. We have our risk budget and we trade it based on 100 markets. So every trade is very small now. Back in 1980s, when I traded for Chesapeake and for Rich, we traded 20 markets. And so every market could be, of those 20, we didn't have nearly the diversification, but they could make a difference, positively or negatively. You could get your ass kicked if you had a big position in something, or you can make a lot of money. I made 30% in 1980. I think it was 86. I made 30% in December of 86, and all in heating oil.
Wow.
So is that preferable versus 100 great markets, massive diversification, small little bets? So you never get crushed, you never get killed. dependent upon your overall risk budget and leverage that you're using. And so if you have a nice trade in palladium, it makes a few percent or 5%, let's say, but not like the old days where it would have made 30.
Right.
So this is an advancement, but if it's the only big trend, no good.
Right. I feel like it's an advancement from a risk perspective. From a return perspective, it seems like now we need more trends in order for the total portfolio to make money, right? Or the
Of course, but there's no reason to think that we won't get more. We're trading more markets. I mean, anybody could pull out 20 right now and say, I'm going to just trade 20 random markets, or I have a reason to believe these 20 markets will do better than 100. Go ahead and do that. You don't see people doing that, putting the money where their mouth is. No, because we all believe that one of the core beliefs in trend following or systematic trading in general is that all the trades have the same expectation. So there is no reason not to trade lots of markets, and because they all have the same expected return. Now, if you pretend that heating oil, unleaded, crude, Brent, and gas oil are not really the same market, then you may get in some trouble when you have some losing trades in that energy sector, or all the grains are pretty correlated as well. So you have to take all of that into consideration. But trend following theory is that there is no opportunity lost by trading more markets. And people are free to trade fewer markets, but no one does.
right. But I could argue perhaps that you have a point of diminishing returns, and then you need so many trends simultaneously that it's almost impossible to happen, that you might always be perfectly balanced, right, between no trends and trends. But you could counter argument with an 08 or hey, when things start to really happen and start to move, you're going to see trends across the board.
Yeah, I mean, I think the analogy I use, which I don't think is that great, so forgive me, but it's like having an edge in blackjack and sending out 1,000 people to 100 different casinos.
Yeah.
The same edge is being played out all around, but it will look like, we should stay away from a certain casino, or some of these other people have more talent than other, but they don't. They're all following the same system. So once again, I'm going to be very hard-headed on this and stick with my idea that theoretically, it does look like stocks are superior. They're superior in every way. Trend better, make money better, and all of the other markets have a problem. But in my opinion, I'm going to stick with trend following orthodoxy, in that they all have the same expectation.
Well, and this whole conversation we're having assumes a whole hell of a lot, right? That U.S. stocks will continue to be the best performing thing in the world, right? They've just had their best 10-year run ever in their history. And there's been periods, Japan was flat for 30 years. Canada, I think, is still underwater from 20 years ago. China went to zero once back in the 80s. Russia went to zero. So I feel like whenever we're having these theoretical discussions of like digging into the weeds on trend following versus just holding FANG, right? Like, it ignores the history that there's huge risk to those stock positions. Hasn't been seen in 10 or 20 years, but huge risk.
Huge risk. I mean, I think we saw it this year. I'm not going to
we got a little taste or a smell of it, but yeah.
I mean, I think just because the market rallied doesn't mean it didn't seem like there was some undue risk taken.
Let me ask, you mentioned vol targeting. I was having a debate with Jason Buggett, Mutiny Funds, the other day of, to me, if I'm a trend follower, and I believe this is how you run your portfolio, right? Of, like you were saying, we're going to have the same expected return across each market. If it trends the way, if it has a 3 standard deviation move in heating oil, it's going to return the same amount of money to me as a 3 standard deviation move in euro currency or whatever. Because at the entry, you're sizing it based off some risk proxy or your distance to the stop, right?
Right.
And then you're knowing what the contract value is, so you'll have an expected return. So that's not what you mean by vol targeting, correct? Because you can get a target overall portfolio back-tested vol by adjusting your risk that way.
Right, normalizing the losses. using the volatility at entry and keeping all the losses the same size and then the same dollar amount, that's not vol targeting. Vol targeting is more when you have a big profit like palladium, you scale it back whenever the volatility increases. So if an average day in palladium is $10 when you put it on and it gets to be $20, maybe you get out of half your position, something like that.
And but you're saying that's no good because you're you're cutting your profit short, which is opposite of everything you've learned in the Turtle Trader rules. And
I definitely think it's you should take the freedom that profits give you, that this strategy kind of allows, to be very cowardly with losses and preserve your capital. But then when you have a profit, you need to be more willing to let it turn into a big, huge monster winner. And you can, if you have this dichotomy between those two, I ask people all the time, are small losses the same as a give back on a big profit? And most of them say, yeah, it's the same thing. And I'm just like, oh, darn, I just can't go there because I like that freedom that I have with a winner. And I'm very worried about taking big losses. So I keep those pretty small. So maybe I'll risk 25 basis points. I tweeted this the other day. I'll risk 25 basis points on a loss. I will let my open profit fluctuate 250 basis points in order to make 2,500 basis points. So I like that. I think it works. And cutting your profit short kind of rubs me the wrong way. And I think there are better ways to navigate the markets and the choppiness and what's going on these days. There's better ways than using volatility targeting. And I think another thing that happens is clients love it. Oh my gosh, they love it. We were just told from the day one, like clients won't make you do bad things. And clients are to be resisted. They want you to take small profits and do all kinds of, suboptimal ideas. And so
that's one of the market axioms, right? Nobody ever went broke taking a profit.
Yeah, exactly. That's what they say. So in this particular strategy that we have with 40% winning trades, that's a bummer to have such a low win rate. You need to do everything in your power to try to capture as many mega trends, outlier trades as possible. And so I'm sympathetic to what happened in Palladium, come up with a good strategy. I just don't think vol targeting is the best one to lock in some profit. And they'll say, well, we're not locking in profit, it's more risk control. Well, I'm keeping my losses to 25 basis points and I'm maximizing my diversification. So I think I'm doing a pretty decent job on the risk management. But honestly, if I'm long Tesla now, I got to let that thing go. Take a little bit of profit, that's fine. Don't worry about it. But
take your principal off the table or something. But
yeah, but don't try to call the highs and do something materially that really limits that upside that you have in these. They're hard to find. These mega trades are hard to find. Don't limit what they can give you.
And it switches the whole profile from a convex, right? And then it caps that upside, which is the whole point, which I like that 25, what was it? 25, 250, 2,500. That
risk
explains
25,
convexity really easy.
Yeah, risk 25 basis points on a loss, but you may have to let that profit vacillate 250 basis points. Who knows? That's the freedom that the profit will give you to allow you, because the computer will say, let those profits run. Be liberal. Don't be so tight with your trailing stop. Follow the system. Follow what the math says. If it didn't say that, I wouldn't do it.
Right, and it's kind of back to the issues with the Sharpe and differences in upside volatility versus downside volatility is really what we're talking about, right? If I go inside a month from up 8% to up 4%, are you really all that upset? Versus, you'd be much more upset if you're from down 4% to down 8%.
Exactly. What if we had a system where we could guarantee we just have no losses? We just have no losing trades. They're all winners.
I've got one. You want to hear it real quick? You buy today, sell when profitable.
And so
Never have a loser.
if we had that, what would you do with those winning trades? What would your litmus test be? How would you grade your group of traders? Whoever made the most amount of money. And
Right.
so I think do whatever it takes to make the most amount of money, but limit your losses, take small losses, and diversify.
And I wanted to come back. We were mentioning all the commodities, and just commodity trend has been thrown around about a little bit lately as the answer to inflation. I kind of push back on that a little bit of like, well, that's not its mandate. It's not trying to capture those inflationary moves. It probably will, but you might have too high of a carry to do it. What are your thoughts on it? Just trend following as a inflationary hedge and commodity trend in particular.
Yeah, well, like I said, we haven't seen that in a long time. So we've been short all the commodities. I'm looking forward to getting long some commodities. I think just the data is just full of the long trades are so much better. And I'm just selfish. I don't know if it's going to be inflation or weather or what it's going to be. I don't really care. But I know that it's very important as well to have long and short commodities because all the shorts are sort of correlated. The bond shorts and the currency shorts and the commodity shorts and the stock shorts are all kind of correlated. The longs are kind of correlated. So it's great to have longs and shorts in your portfolio. That's diversification right there. And it's great to have some long stocks and short stocks, long commodities, short commodities. So it's just hard to find some long commodities now for risk control purposes and for profit opportunities. So I think, what's out there, copper, silver, and gold. That's great. It's a good start. Let's get going.
Right.
Yeah.
And then you added Bitcoin to the portfolio markets, right?
I love Bitcoin. I think Bitcoin's a great market. I like it for a couple of reasons. One is that, I think it's responsible to do some analysis and, figure out how to handle markets that are correlated, like heating oil, crude, and unleaded. It's not three different markets, but it's more than just one market because they do different things. They have different chart patterns. The trend following overlay will give you some more diversification. It's just great to have a market like Bitcoin that's not like anything.
Yeah.
And I love that. It's liquid. I could care less that I don't understand it or no one understands it. I think to some degree, psychologically, it's a huge edge. Here's the one market that no one understands. So you got to be 1,000% dedicated to use your system. So, I don't really look at all the other markets that way because I don't understand soybeans either and have no interest, but it's really great that you're forced into a systematic approach with Bitcoin, unless it's a religious thing for you or whoever's trading it. But just for me, thank God for another liquid market that's different.
Right. So just another diversifying, right? It could have been some new commodity metal that they found in the ground. Who cares? It's got a liquid market. I'm going to trade it. It's got data. It's got price trend.
We just started trading iron ore this year. So that's another good market. I'm always very happy to, over the years, just collect, and you end up with 100 or so markets that really make a difference because there's so much fun having on, 100 small bets all around. It's really easy to sleep at night. You get your leverage, your overall leverage is correct. You like it. It's not too much. You have a few stocks, a few commodities, currencies, and interest rates, long and short. It's just suits my personality. I came from an accounting background and I trade futures, but I never left my conservative nature of really disliking. And I was thrown into Richard Dennis and the Turtles in 1983. And with 200% returns, I lost 60% in one day. So,
Whoops.
Yeah. So you can't have those returns without that volatility, but I'm very happy with the way it's all set up now. Much better, much more suited to my personality.
Did they have you ever on the trading floor back in the Turtle days?
No, I went down to the floor once and saw Rich go into the pit and trade some S&Ps or something. But I did get on the floor to visit. Yeah, you're right. I was on there to visit a couple of times. So yeah, I was very happy to be upstairs.
So we sort of buried the lead and started getting into the weeds before asked you what you're up to at Chesapeake these days. So want to take a quick minute and just give us the elevator pitch on, what your guys' focus is currently and what program you're excited about.
Well, we've tried over the years many different programs, and it just we never enjoyed anything other than fully diversified, and long short and trend following. Pretty much trend following only is our motto, and we have a mutual fund that basically has the same portfolio and strategy as our LP, and maximum diversification, trend following, single stocks. We trade the single stocks, and believe it or not, we trade them with trend following in the same systems, long and short. No reason not to. No interest in handling stocks any different. But I think 15% of your money in the stocks is probably enough. I remember doing some analysis, research on the stocks, and they're so uncorrelated so often that you can definitely get lulled into trading a lot of stocks until that one big sell-off like we've seen every now and then, and this year as well. So I'm jealous of the stock market's return and wish that we had those similar returns, but I'm really happy to be trading a few stocks and a lot of currencies, commodities, and interest rates.
And so let's dig into that with the single stock. So, right, if I'm learning about trend following, reading some of these books, and I go create a portfolio, I'm probably going to have, like you're saying, a couple energy sectors, couple currency markets, couple grain markets, and then usually I'll pick the S&P or Russell, a few stock indices. So you're saying I don't want to own the index. I want to own the individual stocks for a further push of diversification.
Exactly. And then you want to set that up in your portfolio in the exact same way that you did your other markets, without any regard to historical performance. Well, maybe the yen was the best in your back test, and crude has been really good in the back test. Who cares? You added in the wheat and the corn and the beans and the Swiss franc. And in the same way, find a few stocks that are different and then don't look to be too correlated. I think one of the great things about the trading the individual stocks this year is it gives you an opportunity to not be fully long, in January. And so we were short some stocks. Not all stocks go up. We had different, we were flat some stocks. And
wait, hold on. That might bear repeating for any young investors out there. Not all stocks go up. Are you sure?
Well, these days it looks like there's just a handful that are carrying that index that you mentioned, the FANG stocks. But you definitely, one of the lessons of 2020, especially in the stock market, is come in with some shorts. You cannot come in and when the market starts crashing and figure out how am I going to get out of these longs? How am I going to get short? It's better to come in short. The CTAs are going to come in short some currencies and grains and commodities, and long the bonds and long gold. So they were doing pretty well, not being all long stocks. But even if your stock sector is 100% long, like you would be if you only traded indices, at least trading some individual names gives you some more diversification and a chance that you won't be fully long. It's kind of odd too, because what is Jerry saying? I'm actually saying if you did it perfect, if you were like a genius and you set up this portfolio perfectly, in the biggest uptrend in stocks history, which we've seen a lot of those recently, you would still have some shorts. You were able to find some stocks that didn't go up. Pat yourself on the back. That's exactly where you want to be. And CTAs are kind of like, you need to embrace that. In the same way they would embrace not being long every commodity. We made a killing in the metals or in energy in 2014. We didn't have to be short every commodity in 2014. So in the same way, your first desire is diversification. Stop trading those indices that all look the same and add a few single stocks from different sectors, different countries. Look at China. That market has just skyrocketed recently. So have an ADR from China or two and cover the world and cover the sectors and really offer yourselves the same level of diversification that you want in the commodities. No CTA would ever trade the Goldman Sachs commodity index or the dollar index only. Of course not. So don't trade those indices. You've got to open up that portfolio and find the magic of a few stocks that are hopefully won't be so correlated. And if they're correlated like they were in February, then hey, your shorts made some money.
Right, it's like a confirmation signal. But two things there. One, aren't you introducing like some selection bias into the process there? So, why not have all 500 S&P stocks?
Well, just for practical reasons, but in the same way that we set up the futures portfolio, we choose the markets we're going to trade based upon correlation and based upon liquidity. And so stocks are a little bit different, and there's so many to choose from. You have to set up a rule for yourself on how you're going to choose them. And then once you choose them, stick with that universe and trade that universe for as long as you can.
Right. So you're not pulling them out of a hat. You've got a selection process and meet the rules, and they come into the portfolio.
Right.
And then secondly, it's interesting to me. I think people know this intellectually, but they might not reflect it in their portfolios. As you were saying, the S&P is essentially a trading system, right? Of like which stocks come in, how much weighting there is. So trend following the S&P is like trend, you're trading a trading system in a way.
Yeah, it's like trend following the Chesapeake NAV.
Right. You ever tried that?
No. So I don't know what, all of these markets in there are markets coming and going all the time. You've done this back test over your back test of the S&P. There's been many different stocks. The weightings keep changing. What is this back test even telling you? I think a great idea is to trade all 500 stocks individually or a sample, 50 or 20 or 5, whatever. You don't have to trade them all. Just cherry pick the ones that give you the most diversification in this exact same way that we all handle currencies, commodities, and interest rates. I'm just saying, treat those stocks in the exact same way, the same attitude. Try to get out of your head all of the stuff that's been put in there over the years about stocks. That's a big challenge. I would go to my turtle friends over the years and I would say, I'm trading stocks. And they'd say, oh, I'm going to look into that as well. And I've got a lot of ideas. And I'm like, what do you mean ideas? Would you just trade the stocks with trend following? No. And so I grew up on Wall Street Week and Marty Zweig, but I find it a challenge as well to get all of that noise out of my head that's been put there that's has nothing to do with trend following.
And then most back tests, the stock indices aren't the best performers as well, right? On most trend following back tests?
Of course. I mean, how could they be? It's an average. Some of those stocks you would want to be long. Some are in an uptrend, some are in downtrend. And it's the very definition of muting an outlier move. You want to pull out those stocks because you'll get your fair share of 500% movers. And you just need to, size it based upon its own volatility in the same way that you handle all the other markets.
So is Tesla in there?
I was lucky enough to trade Tesla. It's weird. It's very liquid and it's different. And that's my litmus. Is it different and is it kind of weird? I have WWE, Tesla, Canopy Growth, marijuana. I just wanted to try to find stocks that really The numbers said they were not correlated. And then my brain was saying, yeah, these are kind of weird industries, weird companies. So I was lucky enough to get Tesla in there. But I'm not going to look at the chart right now because it could be down 100 today. Who knows?
I know, I haven't seen, but that thing's insane. I somehow was on both sides of that trade all through March there. I owned the 300 puts and got had to get rid of them before they went down there.
Yeah.
Which is kicking myself. Where to go? I think it went down to like 250 or 270 before rallying all the way back.
Yeah, kind of crazy.
There's also, it's kind of cool that you could kind of fine tune. Nobody wants to do this, but you could have bespoke portfolios of sectors of stocks in each sector to protect different investors, right? If I'm a Tesla exec or something, which people have promoted for a long time, of like, hey, you'll never go broke. Is it Paul Tudor Jones with a 200-day moving average or whatnot? But right, you could have trend following on all these different sectors to protect a founder or an investor from a deep sell-off across the sector.
I don't think there's anything better than applying your trend following system to an individual market. It's going to work so well, be so clean and less noise. Then I just never have understood this whole idea of mixing in a lot of different markets. I want to be, long copper and short aluminum. I don't know what the base metal sector calculation would look like in that index. But I wouldn't be long copper, I'm pretty sure. So I'm happy with being long copper and short everything else. It's really, every day I just come in and look at my portfolio of longs and shorts, and I'm just like, so much fun. I couldn't even tell you how much I love that.
And how far can you take this idea? So can you go like the Saudi oil contract or the Chinese oil contract and take this diversification idea even further and further?
Oh yeah, I mean, I got pretty excited recently when I was working with you guys and doing my research on China commodities. And once again, I'm not that interested, in finding another gold contract or a crude contract, but it seems that there are some really unique commodities in China and around the world, in different countries, that could add real diversification to the portfolio and not just be another market that looks very similar to what I'm already trading. So I think the sky's the limit. Once again, all the CTAs really require is liquidity, diversification, exchange traded, let's say. But even some people have moved off to more of an over-the-counter commodities, things that don't trade on the exchange.
Yeah, and I think there's a whole nother portfolio when your head wants to explode someday of, into kind of like you're saying, over-the-counter contracts that have their own dynamics and basically could create their own price data stream, whatever I'm trying to call it there. So just back on the stocks, when you were saying 15%, that's what you would recommend someone, that's just your portfolio limit of what you'll go up to in the overall portfolio?
Yeah, once again, I think it's just based on analyzing the real amount of diversification you're going to get in stocks. And it's a little tricky because most of the time, the stocks are different. They act a lot different, and you do get real meaningful diversification as long as it's different industries and sectors and countries or whatever, things like that. But then all of a sudden they all go down like this year, and you're like, where's my diversification? So you are tilting the odds more in your favor if you're using trend following and you're using different stocks, because you needed to come into that February period with short stocks. So
right,
never going to be quick enough every single time to turn it around. Your system, my system needs to be shorter term. Yeah, it could be shorter term. You could optimize your system. You could change it to try to make money in 2020. But what does that do for all the rest of the period? How about taking what's right staring you in the face and is totally available, which is different markets that, some of them may be short, and shorts don't do very well. They don't make as much money well, they can really bail you out and help you in a period where everything is going down, like we saw in February, March.
Let's change gears a bit. How you've been on record, I think, for saying a very heavy percentage of someone's overall assets should be in trend following. How's your feelings on that evolved over the years? Where are your feelings currently on that?
Man, that's a good question. I mean, personally, I'm just, I think it gets back, I'll build my case for this. And it just goes back to the fundamental principle that I said earlier, which is all the markets have the same expectation. And that's from a trend following systematic point of view. Stocks are not better trenders. They have been, they look like they have been, they look like they will be, but more than likely they will not, the commodities and the currencies will catch up soon and have some really nice trends. And then I think the second part to that is I'm just not willing to make a material investment in a buy and hold that might make me 8%. But in order to get that 8%, I would have to risk, historically, we've seen drawdowns of 50% plus. So I just take that off the table, that no, I can't do that. I've got to use small losses. I've got to have longs and shorts, currencies, commodities, stocks and bonds, maximum diversification, price only, a rule-based. Along with my small profits, I'm going to have to play for big gains. And so I just cannot sleep at night allocating a material amount to equities just because they've always gone up. And I'm not sure they're going to continue to always go up. And as you said earlier, some of the countries we're getting to see that outside of the US, it seems that countries are falling off this list of countries where you can just invest in the stock and eventually they make new highs. It's been a long time in some of the European countries and Japan, I guess, as well. So I think that my case is built upon theory and what I believe to be true. And the period that we went through before 2008, where CTAs made more money than the stock market and had less risk, of course. And so I'm going to have to stick with that theory and the experience I had and just sort of wait for things to change, as I've spoken about getting the trends going back in the commodities and currencies.
And as you're saying, you get a little stock exposure anyway inside the portfolio.
Yes.
Less risky before 2008. What are you basing that on? Basically, they're rough, sharp, return over vol?
Yeah, I mean, I think that most of the analysis that CTAs did in-house and then independent studies would show prior to 2008, trend following was wonderful and it made its Sharpe was higher than long only S&P. So, and it wasn't that long ago, 2008, where there was the lost decade in stocks.
Yeah.
It didn't last very long. So we were really looking good then. And I think that I'm another proponent of just because what has happened in the past, that is much different than a 5,000 trade sample size. So long only equities just doesn't have that robustness that one can get from, running a back test on a CTA system and counting up those entries and exits and really saying, hey, there's an edge here. And so the only thing we have going against this is real-time performance recently. This is the big thing.
And I would say recent performance, right? Like it almost is counter. It almost means it's not going to happen again versus people believing it will happen again.
Yeah.
Like I feel like the only thing for certain is these next 10 years are not going to look like these last 10 years. But
yeah,
they'll be proven wrong. So, and then since that 2009, right, I just want to go through this list of trend following is dead articles or or excuses. So I'll go one by one. You can tell me your thoughts. So it's dead because it's too big. Like after that decade you were talking about, assets flooded into their AQR's mutual fund went to 14 billion or whatever.
Yeah.
So trend following is too big. What are your quick thoughts?
True. I think that's the reason we all had to go longer term. So that's a bummer. The trends were going to be there. The trends were there. We made money on trends. It was just choppier, more volatile. A worse investment, still profitable. Yeah, so nobody really likes it to be too crowded. There's no reason to deny it. So it's a little bummer, but certainly not the reason we haven't had massive commodity uptrends like we used to see. There's other reasons for that. We may never see them again, but it wasn't been logical for all of us to do that back test and realize, hey, this is a really good way to trade.
Right. But if I'm AQR and I'm at those billions, I can't materially trade because the position limits some of those commodity markets, right? So
there is a limit to your AUM, and that was my stock answer for many years. At one point, we traded over 2 billion. That was my stock answer, that you don't want to run yourself out of these commodity markets. They're so great. It's your value add. It's what you can bring to the table, and it makes your portfolio so much safer to have long and short commodities along with the financials. Yeah, if you get to a point where your commodities can't be 50% of your portfolio whenever you want it to be, need it to be, then that's going to be a problem, long-term performance.
So fair to say it's a problem, but not the answer to the problem.
No, because what has happened recently is the opposite of that. The fewer the commodities you traded, the better off you were. So that means you had bigger bond positions and bigger stock positions, which were the only things trading. So having too much AUM and being kind of irresponsible in that area to your clients worked out well for you and your clients.
For now, this is the theme of the show. Irresponsibility is paid for the last decade. Yeah. Next trend following its dead meme is they've had the bond tailwind for 30 years. Now they won't have that with interest rates near zero, so they're not going to do as well.
Well, more than likely, as I've said, we need to get some contribution and profit from commodities and currencies, which we haven't seen in so long. And I think I've seen some analysis over the past few years from Campbell and Niederhofer that due to the term structure of the bonds, we won't make as much if bonds go right back to where they were many years ago. We won't make as much on the short side as we did on the long side. I don't think we need it. What we need, it's not going to matter if we don't get nice moves back in the commodities and currencies again.
All right, next, the trend following is dead because of all of the Fed actions and saving the day. So these trends don't have any ability to move because basically the Fed puts a limit on trends.
Well, it definitely has helped the bond market. The CTAs crushed it in the bonds. The only ones dumb enough to stay long bonds as rates were getting close to zero. Certainly you can't make more money in the bonds. CTAs crushed it. That was wonderful. We got some trouble with the stocks because we only trade indices for most of the people. And then the V bottoms just really hurt. But once again, it's the same message for me. If the Fed could be blamed for a lack of inflation and lack of commodity trends, currency trends, then yeah, they're to blame. But really, I'm to blame if I have chosen a methodology that allows this to occur, and especially if it's not going to turn around. So I need to get some intelligence or figure something else out if the next 10 years are not going to look a lot different.
Right. But it's also weird, right? Because then your intellect wants to tell you all this meddling, all this printing of money is going to cause those commodity trends. So it's almost, and it's going to cause moves in the dollar and whatnot in different currencies, but it's been proven wrong so far. right? They printed all that money in '09 and basically nothing happened.
I grew up in the 70s with double-digit inflation and interest rates, and then graduated college, Milton Friedman, and I thought I understood how all this stuff worked with money supply. So please have a guest on that can explain to all of us
Why that doesn't work anymore.
what happened, what's happening now, where we really don't see inflation now. And so, how did printing money in the 70s obviously yield to high inflation, but since '08, it has not. We've not seen that. What are we all missing?
And then my last trend following is dead one is everything. Basically, there's no power of diversification anymore. That crude and cotton and corn all move together based on globalization and real-time demand manufacturing. I'm butchering that one a little bit, but any thoughts on that? Basically, the concept of globalization has made different commodity moves less likely.
Well, I definitely don't know if it's globalization, but it definitely seems to have occurred that. So maybe I still, unfortunately, and have always looked at commodities as maybe like four or five sectors: grains, metals, energy, and softs, and everything else. But they all pretty much look the same now, don't they? And that is, they're basically in downtrends, and downtrends are no good. Downtrends are only good for diversification purposes most of the time. Obviously crude in 2014, I'm wrong, and I've made a ton of money over the years in some short trades, but the longs are so much better. But it looks like I was incorrect that there are four sectors in the commodities. It looks like there's one sector. It's called commodities. It's all been down. My portfolio was heavily weighted in commodities, and maybe it should have been 25% rather than 50%.
Do you feel like those days of an endowment having 5% long only commodities are over? It seems like a pretty high risk, right? That was a rather standard allocation, even 5-10 years ago. But
yeah, I don't.
Anytime you run the stats, commodities are the most volatile and the least return.
Yeah, one of the things that's very frustrating, or kind of just people. I know people are smarter than this, but they'll write an article, and to the degree that gold has done well recently on a buy and hold basis, that's the degree you can include it in your portfolio. And so I don't think there's any commodity outside of gold that just so happens to have gone up over time, because this is their system. What have stocks done from a buy and hold perspective? What has real estate done from buy and hold? What have bonds done from buy and hold? What has gold done? And that's the extent. And here the CTAs sit with, hardly any of our commodities are worth a damn on buy and hold. But if you let me wrap it inside my trend follower, they all spring magically to life, and they add value. They add diversification, they add profit to your portfolio, but I've got to wrap it up at trend following. And so I think that's the lesson, is not the individual markets per se. Trend following can take something that loses money on a buy and hold and raise it from the dead. And it's a beautiful addition, long and short, to your portfolio.
Right. I feel like we should have 10, 15, 20 years ago renamed it like smart commodities or enhanced commodities or something, right? And probably could have gotten some of these big allocations from those who wanted a commodity sleeve. Because really, yeah, I'd much rather have long or short commodities than just long commodities. Paying the roll, paying everything. You're just almost guaranteed loser.
Yeah.
And then I had one more thought on that globalization concept of, to me, and you see this in farming and in oil, right? Like we can get down to the oil, we can drill 3,000 feet down, 3,000 feet sideways and get oil that was trapped in there. So the technology, I feel like, is improving faster than the demand. So we're always creating the technology to grow more of it, get more of it out of the ground, versus the population growth and the demand that's there. I feel like that's kind of, for the last 10 years at least, we kind of ignored in that mining and farming space, but it's there, and it's causing that constant downward pressure of more supply.
Yeah. Oh, yeah. I see what you're saying now. I was thinking of something else when you were saying that, like technology creates these surprises. And that's one of the benefits of trend following, is that it's so amazing on surprises. You know, we see things that are happening all the time we've never seen before in our entire life, politically and economically, and the pandemic and stuff. And it's a real benefit to have an approach that just buys these breakouts or follows these moving averages, irrespective of the price is too high, it's too low, the majority is saying this or that. And it really just fits into your portfolio if for no other reason than that. You know, who is going to get short or get long these bonds when they're so the rates are so low, and who still is going to be long equities, you know, when everything obviously is overvalued, and you just don't see these things coming for whatever reasons, technology or things that happen in this world today. It's really fun to be on the front line and see your positions work out over time when nobody really expected them to.
Right, and it's the whole feeling of like, how in the world were you in that position? Well, and you can't take credit, right? Like, well, just we're in all the positions. A lot of them don't work out. Every now and then they work out because of some surprise. But we're there. We're positioned there for when that surprise happens.
Yeah, I back in 88 or 89, around that period where I just started Chesapeake, we were in Richmond and we got word that Paul Jones was speaking at UVA. So we all drove up to UVA and to hear Paul Jones speak. This was our late 80s or 90. And he talked about that being short the Nikkei trade. And he said that when he made all that money being short Nikkei, people just loved him. And they just thought he was amazing that he made all that money. And he said, but what they didn't want to hear was that was my fourth time going short.
Yeah, right. And that's was pretty good to hit it on your, right, 1 out of 4. Some of these could be 1 out of 44.
Oh, I lost so much money before that 2014 crude short, just selling the crude, you know, at the lows over and over, and then buying it at the high, going long at the highs all throughout 2012. And then you finally get rewarded. It's, you know, you've got to take into consideration all these trades, not just the good ones.
I hear you. I've been there. That's what's so weird, what you said before. Like, if you just model these, you might end up with a portfolio of like 17 markets, right? You're going to be like, this is no good. Gold looks no good. Crude looks no good. You're going to throw them out. So it takes some resolve to be, no, I know this individual market doesn't test well, but instead of messing with its individual parameters, I'm including it in the portfolio, and I know it's going to create a better portfolio overall.
Yeah, exactly. I think things like that mean a lot, and they're going to determine how successful you are. And so they're so goofy, and it's not really fitting in with most people's personalities, that you would kind of hope that that would make what we do more resilient, as far as being able to last a long. Who are these weird people with these weird thoughts trading all these markets the same way without paying any attention to any fundamentals? But we're all sort of subject to the trends in the markets and just trying to stay alive and stay flat until we get the big trends. And you've seen these papers over the past couple of years. AQR wrote one for sure about this in-depth analysis they did. And they said, look, here it is right here. CTAs didn't make money because there weren't enough big trends. That's it. Nothing else, everything else. The trends they got, the trends they had, they captured the same amount that they always did. But unless we get, we put ourselves out there for outlier trades, we've seen them, they're there, they happen. We just need to have more.
Right, and I feel like the better thing would be, is it asleep over there in the corner? Because it's right, it's not like its head's gotten blown off. It's just been, and not even all that bad. It's been flat to up. So it should, I think we need to change the narrative there too. Is trend following asleep and just holding its breath, waiting for that big pop, versus dead implies that it's lost tons of money, which it hasn't as as an average, as an industry.
True. Yep.
All right. We're going over time here, so we're going to move on. You got anything else you want to say on the Chesapeake or program or anything?
I don't think so. You've allowed me to get all my talking points in, and I appreciate that. And you made it sound like it was your idea, so I didn't have to force my way to talk about vol targeting or stocks and things like that I'm really passionate about. So I thank you.
Again, Jerry, we're going to do some quick fire questions here, how we end up every pod. First name, Ralph or Jerry?
Ralph, after my father, and I was called Jerry, and that's fine. Either is fine. I'm proud of my father being a junior.
I like it. And now there's a rumor you have 4 dogs and a bird.
Yes, I have 3 Shih Tzus and a black lab and a bird. My bird is, she's pretty wonderful. Great pet.
What's your favorite? Which one's your favorite?
Oh, I love, well, the black lab is hard to beat, but the cockatiel is my, she usually sits on my shoulder, and but she's very loud, so she would have been very distracting today.
That's the bird, the cockatiel?
Yes.
It's related to a cockatoo?
I think so. Yeah.
I don't know my birds. I dated a girl in high school whose family had birds in this room, and it was scary to me a little bit. A lot of noise. So favorite city, Richmond or Tampa?
Oh wow, I'm going to get in trouble on this question. I love Tampa. Tampa is my home, and I have a lot of good friends here. And unfortunately, I would be a little lost back in Richmond. So I'm going to say Tampa, but actually I love New York, and I miss New York, and I can't wait for this to be over so I can go back to New York and enjoy my restaurants and things I like to do up there.
Well, I need to now hear one of the favorite restaurants and favorite things you like to do up in New York.
I like to mostly restaurants, I would say, around the West Village, Bar Pitti, Raoul's, kind of really fun things to do up there. And I have 2 children who live up there. They're grown, and so seeing them up in New York and seeing them enjoy New York City is really fun for me.
I've got a life hack for you that also fits into your diversification persona. So, but we also do it in New York. Diversify your restaurants. So we'll have apps at one restaurant, entree at a second restaurant, dessert at a third restaurant.
Oh,
so you get a 3 for 1 in one night. Get to see the city a little bit. It's good. And so I don't know if this is a favorite, but just if you hadn't answered that ad back in '84, what do you think you'd be doing now?
That is a very good question. I think about that some. It's hard to say. One of the things, that I would say that getting so in depth in the trend following and having that experience with Richard Dennis, it closed my mind to almost everything else. It was just me and trend following and this early success and continuing to build off of that. And that's all I was interested in. And there was so many other opportunities that take a guy like Salem Abraham, he's just a fantastic businessman. And he is a great trader and had so many different investments, in Texas and all around, and just had his more open-minded than me. So I just got closed down, and it was all about being a CTA, and that was it. And I missed so many opportunities, but I probably would have been in the stock business in an RIA firm or something like that, but probably an investor, and had a lot more different strategies or different types of investments than I do now, which is, pretty much real estate and my trading.
Right. But it's worked out pretty well for you, I think.
Yeah.
And then we ask all our guests favorite Star Wars character. Hopefully you've seen one or two of the movies.
I have. I'm going to say R2D2, or whatever that is. Yeah, that little.
Yeah, R2D2, the droid.
Yes. I'm more of a Lord of the Rings, but Star Wars. I remember going to Star Wars when it came out, I think in, I don't know, 1975. So,
yeah. We're reading Lord of the Rings with the kids right now, Hobbit. So I'll take your favorite Lord of the Rings Hobbit character as well.
Oh, I don't know the guy's name, but he's an actor. This one actor on that was a Hobbit. He was Sherlock Holmes. He was in the Sherlock Holmes with another famous actor. That man is one of my favorite actors, and pretty sure he was a Hobbit. But I watch a lot of movies and Netflix and things, so I don't have a good memory as it relates to remembering all of the characters. But I'm pretty much this COVID thing shutdown has really upped my Netflix game quite a bit.
Yeah, I sold Netflix short once back in like 07 or 11 and lost some money, so I still don't have a Netflix subscription because out of spite. I don't think that's how I need a system, right? That's not how it's supposed to work.
No.
Well, thanks, Jerry. This has been fun. Hope to see you when all the lockdown stuff's over, and welcome you back anytime.
Yeah, me too. Thanks, Jeff. I enjoyed it.
Thanks, Jerry.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.